You should be able to see me too. In 3, 2, 1. Let's see, right there. How you doing, Kamal? Kamal, just out of curiosity, where are you currently at? Where are you located at? And what are you currently trading at this point in time? Yeah, if you could just type it in, that's fine. Okay, great. Oh, fantastic. All right, no worries. A full-time trader, and you've been trading for how long now, Kamal? And what do you trade? Stocks? Oh, fantastic. Stocks, futures, Forex, options on equity. Okay, got it. So this could probably help you. Maybe, who knows? Maybe not. But I'm just going straight directly from a basic foundation component that could help in the way how you trade options. I used to trade options when I started in 1996. So 96 is my 23rd year of trading full-time since 2002. I used to be a database administrator. My background is physics and mathematics and computer science and math. After that, I traded from stocks to day trading, options to day trading stocks, then to futures and to currencies. I love currency because that's what I used to teach because it's 24 hours, almost 7 days a week, and it has a lot of advantages compared to trading options, stocks, or futures at the very beginning for traders. I've been teaching now since 2003 as well. 2003, 2008, 2007, I moved here to the US to be basically when I got married. And then I grew up in Australia, totally different in regards to trading retail component. And then I wanted to find out more how the education industry works in the US. And in my journey, got to go to the trading floor, and I wanted to utilize and see what it looks like, basically what it does institutional type of trading, because as retail trading, I wanted to know more how to get more on a wholesale price point rather than retail price point. So that is my background. So since you are a trader, here's a quick question for you. What is technical analysis? Since we only see a two-dimensional chart, mind you, doesn't matter whether you're trading, so let me forward here, also like using trading view. So it doesn't matter if you're trading S&P 500, a chart is a chart, right? So everything can be translated. The chart within S&P, the VIX, the Dow, dollar index, a currency. So notice they're all the same. It is simply a chart. A chart is a chart. Okay. Alrighty. So it's a variance indicator based on historical analysis. All right. So it's pretty good. At the end of the day, there's no right or wrong when it comes to answers. But the major, most important part is to be through here. To be objective. The question is, what is objectivity? We need to define what objectivity means versus subjectivity. So subjective versus objective. Objectivity simply means that if you have facts, you have the data involved to create a statistical component that will part of the decision-making process, everything in terms of the facts that create statistics, statistical measurement, then you're being objective. You're not using your own perception, you're using your own way of thinking, then that is very subjective. And hence, that's why when it comes to trading, as you would know, as you would see here, so you've been trading for 5 years, basically in a novice to intermediate level, inconsistencies, And then, as you would know, trading as a full-time trader, if you're trading full-time, is very challenging, especially if you want to make money in the marketplace. Of course, the market's been very bullish since 2008, that any person who will buy simply will make money in the markets, right? As trading stocks is pretty much just one-sided. It's just basically buying. Well, the question now is what happens when markets simply fall or tank. Unfortunately, for those who trade stocks, it is a challenge for them to short unless they go through ETFs. But since you're an options trader, then it's both ways. You can also buy calls and puts, or you can do to minimize your risk. There are a lot of different strategies that you can basically implement. At the same time, also, you need a lot of money in order to do so because of depending on whatever strategy that you use, right? So, but nevertheless, how do we look at charts subjectively? So, chart is simply, there are two components into it, regardless whether I'm trading oil or you're trading the S&P or you're trading the Dow, you're trading the VIX, you're trading gold, you're trading currencies. So, technical analysis. Let me, where did it go? Sorry there. I'm frozen right here. There you go. So you maybe perhaps can write it down. Technical analysis is defined as the study of price movement or price action using present and past price action and present and past price action to forecast future price action or future price movement. So the key word here, if you want to be objective, is forecasting. So the question is, what is forecasting? Well, we need to define that once again in order to be objective. Forecasting, there's a big difference, forecasting versus expecting. We don't expect, we forecast. Forecasting is creating the probability of winning to forecast future price, either to go up, forecasting to go up, forecasting to drop, forecasting to go sideways. So there's only three ways in regards to price in terms of its movement. It will go up, sideways, or down. Expectation, on the other hand, is based on one's own way of thinking, personal thought, personal perception, personal opinion. So indicators, unfortunately, it's just an indicator. There are mathematical formulas invented by, some of them are traders, some of them are non-traders, some of them are just simply mathematicians, to create some form of probability of where the price is going to go. And the reason being is this is a big question mark. This big question mark creates fear, and that fear is based on uncertainty. When someone's uncertain and they're on fear-based and they're using part of their own opinion, then that's simply is a dangerous component, because it is now at one point on a gambling aspect. All right, sorry about that, Kamal. All right, so from there, when you're using any form of expectation, it is now simply on the gambling part, because there's no facts. There is no evidence. How to create facts to create the probability, to have the evidence involved, is through creating some form of statistics. Statistics is what creates the probability to forecast one's price either to go up, down. And in particular, this particular case, from all these three components, either you will buy or you will sell. Either you buy a put, sell a put, buy a call, sell a call, either create different type of strategies. In my way of trading, either I go long or go short, trading the currency markets or futures. That's basically it. So once you have that and you can only make a choice, part of that personal choice, from a 33% perspective mathematically, that now increases from 33 to 50%. Hence, if you don't have any facts or any evidence of why you have to buy or sell, then you're now gambling. It's like tossing a coin. Either you go heads or tails, buy or sell. And that's based on the 50%, from 33 to 50%. Wall Street Journal created or wrote an article a few years ago after the 2008 meltdown, and dictated that retailers have a 55% success rate, whilst institutions like Goldman Sachs, for example, and during the time had a 91.3% success rate. Currently, they're up around 97% success rate. So that's from the last article that basically I read. And so that being said, if retailers only have a 55% success rate, institutions have 97%. So how can then a retailer beat the market price? The answer is they cannot. And the reason being is, if you are going to be part of the game, there's no way that you will be able to win because you don't have all the resources, all the facts and evidence that compare to an institution. And rather than doing that trading floor, just to dictate. For the past few years, I haven't taken traders to the trading floor, but prior to that, all the way to 2017, I took traders to the Chicago Board of Options Exchange, CBOE, because they're still very active because of the VIX and the S&P pit. Prior to that, here's the CME. Actually, there it is. It's way better. This one, way better one. Actually, this is a better one. The CME, the Chicago Mercantile Exchange, and this is simply what it looks like based on the trading pit, where notice when people are trading in there, you can see who you're dealing with. Not like when you're looking at a chart, you don't know who you're dealing with. Here, it's simply a group of traders based on mass consciousness. One's buying, one's selling. Just imagine people around the world wanted to trade. Also, one intention is to make money. However, here on the other hand, what people do, and they're trading on the trading floor, they're dealing here with big money. Institutions are trading, hedge fund managers are trading in there, even private traders who has more, perhaps $500,000 to more than $1 million. But if you're just using like us, like retail trading, unfortunately, we do not have all the pieces of information like they do, especially when it comes to news. So here's now where I'm going to go through now from the next step. Basically from here is simply, how can you be objective trading the markets? Well, first, what drives the markets? What drives, there's two, let's discuss here. You have price, and then here is you have time. There are two variables, x-axis and y-axis is based on price and based on time. Notice there are no indicators. Indicator is not a component of technical analysis. It's an indicator that indicates the probability of where price would go, whether you're using an oscillator or you're using a moving average. So those are basically what it is. Volume just simply dictates the amount or how many transactions have been transacted within that time frame during that time. So in this particular case, on the daily time frame, if there's volume, well, let me put one in. So here's a real volume for the dollar against the Canadian, the US dollar against the Canadian dollar. So volume just simply dictates that there was, right at this point in time, after this one will end 2 minutes and 1 second, that there is 83,826,000 transactions within this time frame of 4 hours. That's what simply it means. In regards to, in this particular case, the amount of contracts that has been transacted within that particular time frame. So hence, here there's price and there's time. Indicator is just an indicator. It's not part as a component of technical analysis. Yes, it is a factor that we could add in. So the first one is simply, how can we be objective reading charts? First, we need to really look at what price is. If price is everything because that's what calculates the indicator. That's what's been given within the transacted time frame, and that's the amount of price that has been transacted within that particular point. So where you're trading 1 minute time frame, there's a closing price that has been stamped, there's an opening price that has been stamped, there has been a high price, a low price. So there's 4 different price points that will be stamped at a particular time frame. So in this particular case, based on the daily time frame, it opened the timestamp in terms of, sorry, not the timestamp, the price that has been stamped is 51.049 at the opening price. Current high was 52.413, low 50.893, closing 52.154. So once all these price points have been stamped in this particular price, particular time, in terms of daily time frame, yes, oil basis will stop at around 3 o'clock. Later on, the stock market will finish at what, 4 o'clock. Then when the timestamp has been logged in, and this will go through now to the next timestamp or the next candle, the next bar, right? So if price now is everything, the question now is what derives price? So Kamal, if I'm going to ask you, what derives price? What derives price to go up or down? So what derives or what drives the price to go up or down or even move sideways? Right, so someone's beating it up or down. Okay, great. If someone's beating it up or down, but what causes for that buyer or seller to place a bid or to place an ask? Right, so what causes for the price? First question, what causes for the price to go up or down? And you basically said that there is a buyer, there is a seller placing a bid or placing an ask. So these buyers and sellers, there's still something that drives them to buy or sell. So the answer is news. Everything is all news-based. And hence, that's why you as a retailer, me as a retailer, if we don't have instantaneous news that will appear, then we are at a disadvantage. We don't have that black box, we're disadvantaged. That's why day trading is challenging. And the reason being is because we don't have those news instantaneously. Goldman Sachs has a picosecond in regards to news ahead of everybody. Plus, if everything is all algorithmic, in terms of algorithmic trading, imagine how fast that is, that once the signal comes in regards to that news, it goes through straight to their server, and that creates, if they have a picosecond, then they have that even just 1 cent, 2 cents, just imagine how fast it would be. That's how they can make money very, very quickly. But if we, as retailers, and just imagine this, if the pinnacle source is news, and it goes through the media, goes through the server, right? But basically before the media, it actually goes through the trading floor. And whatever is being established, if there's a market maker who creates the markets, they take it, then it goes via the server, it goes via a trader. We're dealing now here with people who have more money, but parts of the server too. There's also goes through a provider. Doesn't matter who it is within the provider. It goes through your computer, and now it goes to you. Imagine the amount of lag that is not happening through there. It's ticking, but it's still pretty slow. But you're on the trading floor, it goes instantaneously. So they're getting a wholesale price point. And with yours, if you're looking at times, sometimes you don't get the price that you want, unfortunately, because that's not going to happen if you're basically trading form based on your computer. Someone will be taking your price before ahead of everybody. You don't even notice. You don't even know it, right? So if that would be the case, if news what drives price to go up or down or sideways, then this buyer seller creates supply and demand. Supply and demand is being dictated that when there's more supply, price will drop, and there's demand, more demand, price will go to the upside. Plus, depending now on, everything will be depending on the trend. Trend, which also be in relation to change of trend, from an uptrend to a downtrend, from a downtrend to an uptrend. So, in other words, a good example is here in front of you. Notice it's trending to the upside, then all of a sudden there's a change of trend that's now happening from here. So these are the things that, different factors, that how do you know then when to buy and when to sell, and how do you can also dictate that when there's a change of trend. So there's a few questions that we gotta ask. Are you trending? Are you trading based on the trend? Number two, how do we know that there's going to be a change of trend? So that's a major two things that you as a trader need to ask. Okay, so ask your question, come out. How do you know whether if you're trading with the trend? Especially, let's say, let's discuss this one. It's in an uptrend. How do you know that you're trading within the trend to the upside? How do you know that you're trading on a downtrend? Especially in options, you need to know directional trading, right? Are you trading with the same direction, or you're no longer in trading with the direction? So how do you know? Great, so moving averages be one way. The reason being is simply moving averages for trending indicators. So notice you're using now an indicator that dictates, a lagging indicator that dictates within the trend. Um, However, how can you, how about without, if just imagine if you don't have those indicators to make it things easier, how can you know whether if you're still trading in the trend? And this is where you now need to define what trends are, right? Objectively. Not bad, pretty close. So, hi, Sulong, welcome. All right, so let me go through now to the next step here. Is it's very imperative to define what an uptrend as well objectively. An uptrend is defined as a series of higher highs and a series of higher lows. A downtrend is being defined as a series of lower lows and lower highs. That's how you'll be able to define that whether if you're still trading in the trend or within the trend. For example, let's take this one. And how do we know that? Oh yeah, based on all these 4 price components, highs and lows are very, very important. If you want to be a trader, especially if you want to make money consistently, yes, full-time retail trading is challenging. But once I got this, that I no longer, if I don't, no longer being part of the game, this is where the consistency happens. What I mean by that? There is a buyer, there is a seller on the actual trading floor itself. And you can see who's buying, who's selling. This is based on the root source of everything. But just imagine this is the big whale, the mechanics of what the whale is actually doing. Because at one point during my earlier years of trading is that as a business person, why would I buy at retail price point and also sell at retail? It doesn't make any sense because now the risk is so huge, but your profit is pretty small. It's different though. I said I was still putting a trade that if the probability of winning is say 80, 90%, however, my risk is huge and with a small profit, will I place the trade? Absolutely. However, just imagine now that if you have an 80, 90, even 100% probability of winning and you have a low risk with a high reward, then just imagine that you would be able to create bigger profits based on that one. So that being said, when I figure it out, after looking at the way how institutions are actually trading, and to be honest with you, the way how institutions are trading is not the way how retail traders basically trade. Why? Because they don't see charts. And I'll prove it to you. They don't see charts when you're on the trading floor. They only use moving averages, especially the 200-day moving average, because there's 200 days, trading days in 1 year. And hence they use it as a form of indicator whether if they're still bullish or they're bearish. If the market's bullish, they will never ever sell. They will buy at demand. They will keep buying at demand. Sometimes they will create different strategies to make the price drop in order for their price to be taken. Mind you, market makers, they hedge their position, so it doesn't matter whether they're on one side or the other side, they still make money. So other than that, if you're trading based on a retail component and you're part of the game, the chances of you losing more than winning is actually higher. So you cannot be part of this scenario where you are trading with institutions. Then how can you then make money more consistently is by being an observer, observing what institutions are actually doing. Once you become an observer, the best analogy I always give to traders is this. Just imagine the big whale and then a small bunch of sardines clumped up together. This small bunch of sardines are your retail traders. If you are in this scenario, using the same system of what retail traders are using, then you'll be a bunch of this, you'll be part of their sardines trading, and next thing you know, all what the whale is going to do is open its mouth, but you don't even realize you're being eaten by the big whale. Who's that big whale? These guys. These guys are your big whales. They don't care about retailers, mind you. They don't care about you. They don't care about me. All they care is what it cares itself. So being an observer is simply you sitting on the sidelines being that small fish next to that big whale, backpacking based on the scraps of retailers. That if you can be able to backpack and you're an observer, then you have the more chance of winning. That if they go up, you go up with them. They go down, you go down with them. They go sideways, you go sideways with them. Then you have a better chance of winning. So the question there is, how can you be that? Well, in every chart, an institution will always leave clues. These clues are your highs and lows. That's one of them. Of course, there are other more factors that's currently being that need to consider, which are, if news is being considered, you need to look at the macro fundamentals of it, because all markets are all connected. And if you're not looking at the macros, you'll also be at a disadvantage. To find that 66% deficit, technical analysis alone won't break it. In my opinion, only perhaps 33%, technical analysis only perhaps 33% to add in to your 66% deficit. So the question is, what is the other 33%? The other 33% is the macro fundamental that you need to look at, and whether if they are in sync. If they're not in sync, then you have divergence. If they're in sync, then it's awesome. When there's divergence, it's also great, because macro fundamentals create, these are your leading indicators, not the use of lagging indicators. When you have a leading indicator, you're in basically within the institution component, you have a better chance of winning, like I said. So if you can define uptrends and downtrends, higher highs and higher lows, let's say this one, this is Texas oil based on a daily time frame. And let's prove this one. We're gonna analyze this. Let's analyze oil, okay? So let's, I'll go through the process with you. And then we'll write the right things down, see whether if our forecast for tomorrow will be spot on. Okay, so firstly, we have a bullish candle right here. When you have a bullish candle, what does it mean? It means that there's more demand than supply. In other words, buyers are currently in control at this point in time. However, when you're dealing with price, sellers will have control, meaning that if there's demand, sellers would be able to create whatever price they want to create. That if it's in demand, sellers will push the price up, right, based on the asking price. If they'll ask higher price, and then the buyer is going to take it, boom, and that's how the price will go to the upside. Two, if the highs and lows are imperative, notice that the current high is higher than the previous high. The current low is higher compared to the previous low. So in other words, you have a higher high, higher low right at this point in time. The odds that the price will continue to the upside is highly probable. Number two, if the confirmed low will be established and will be higher compared to the last low in terms of the actual trough itself, once there is a specific price point that it's been established, and the reason being why is the higher low, that means that no one was willing to sell. The sellers are willing to go below the last low price. That's a good sign. And if the last low price is also higher than the previous low price, then it's a great sign. That's how double tops, double bottoms actually are being formed for pattern traders. And if they don't get the root source of that, And if it's a lower low and they think, hey, look, it's a double bottom, it's a lower low, the chances they're not going to make to where they're going to, in terms of their target point, is highly probable, because that's not part of the realm. So here it is now. So here, notice you have an uptrend, you have a downtrend. It is imperative to know in terms of transitioning of trends from a minor to a major, major to a minor. So all these things need to be taken into account. Does that make sense there, Kamal? There's a minor high and low, there's a major high and low. So right at this point in time, there's a minor higher low is currently being formed. So to create a trend, you need 4 points. 2 highs, 2 lows. Notice you only have 3. 1, 2, 3. This is the last low. This is the last high. This is the current last low that is forming. Unless something happens in the next few hours that the price will come back down. Other than that, from what we see right at this point in time, you have a confirmed low. So if this low is higher compared to the previous low, that now creates a higher low. Here's a question for you. Come on. What do you think is going to happen next in terms of transitioning? So to create an uptrend, which is a series of higher highs and higher lows, what would be the next step? Right at this point in time, you only have a higher low. So in order to create an uptrend, you need a, what would it become of? Exactly, over 0.2, which will create now a new higher high. Therefore, if that's what it creates objectively, there is a third component of technical analysis, Kamal, is you have price, you have time, and now you have distance. That's where you'll be able to calculate approximately of when your price is going to get up in there. Price cannot just go in a straight line. It cannot go up there just over one period in time. It will take multiple periods because price, based on low harmonic vibration, it oscillates. So you notice that it's an oscillation. It cannot go in a straight line. So if the next one will be now beyond price point number 2, which is the high one, 54.766, the current price is at 52.20, 54.76, 52.20, then there's approximately $2.50 in regards to profitability. So if you have a minimum of $2.50 to get up in there, to create now the probability, if you want to make $2, what are the odds that you will make $2? Come on. What now if you only want $1? What's the probability that they will take you? Notice that the probability of measurement will be measured based on the distance. So if you want more than 250, it's like now trading an option. If the strike price is $2.50, say the strike price is at $54.50. If you want to go out of the money, the probability will decrease a little bit. If you want to be in the money, the probability will increase massively. If you're going to go at the money, then perhaps it's a 50-50. It'll get there, but the probability is still higher because we know that the distance from 250 to create a new higher high has to go beyond $2.50. Does that make sense there, Kamal? Bingo. So, and we haven't even used any form of indicator. So imagine now if we use extra indicators to create a confirmation of what we have based on price. So to be objective, number one is we need also to look at any up and coming news that will support or that will create the price to go either up or down. So currently today's Thursday, and then tomorrow, let's see what's happening tomorrow. Bingo, you have core retail sales and you have retail sales. Carney is going to speak tomorrow, but it's not going to affect oil, but it's going to affect the dollar definitely. The dollar will affect oil, whether we like it or not. Why? Because everybody who wants to buy oil needs the US dollar to change basically their money, right? So the dollar index is a very important indicator. Okay, so there's two high impact news tomorrow that could affect oil to drive the price to the upside to get what we want. If not, then at least what is our stop loss? Our stop loss is very minimal, because if we're waiting for a confirmation, it goes beyond that. If we're looking at, say, an indicator component of it, it's too late, right? So here's an example. What do I mean by that? I'll just take the CAD at this point in time, the dollar against the CAD. In hindsight, where's the best price of buying? The best price of buying is at 32.50. Now, if we're dealing here based on supply and demand, then definitely here is where the buying price will be the best case. You have a higher low rate at this point in time, and your stop loss will be here in terms of your guaranteed stop. However, it's still trending down to the downside. So when that happens, see here you have a big boost of buyers looking in terms of the volume. That's great news, right? And then stabilize itself before create another impulse at this point in time. Stabilize itself at demand. So technically, the next one now will be around 33.50, which is now here at supply. So here you have now a bunch of higher lows. So from a higher low, that you can here see higher low. When was the last high? Create a new higher high. From a higher low, create a new higher high. From a higher low, next one is a new higher high if it chooses to. But if it creates a lower high, then you're done. If it's a lower high, then it's going to come back down here again. But the overall trend is still pointing to the downside as of June 3rd, whether we like it or not. Why? Because a bunch of higher highs and higher lows have been broken from a higher high, higher high, higher lows. All of a sudden, you have a lower low right there, another lower low right there, and now you have a lower high right here. Lower high that now led for the price to keep dropping. Whether I like it or not, even though it's a higher high over here, based on a bigger component, still a lower high. Higher high from here to here, but lower high from there to there. Okay. So, who has hierarchy? The higher high, the minor higher high, or the major lower high? The major lower high has hierarchy. Therefore, the odds that it will still come back down is highly probable to retest this demand area, unless they choose not to go to the upside. So now here's the deal. If we're dealing, say for argument's sake, if we're just dealing based on purely supply and demand, and you're buying over here, 132.50, what is the risk? The risk, 32.50 to there is 28 pips. So make it 30. Now, I'm going to do the same strategy using moving averages. And we have a methodology using moving averages. based now on, I call it method 3 because they go in hierarchy. Method 1 is institutional type of trading. Method 2 is using a moving average. After how long, how many hours from an uptrend saying, hey, look, we have a potential change of trend, didn't like it, still within the trend. Change of trend based on moving averages. This one's just simply dictating, hey, look, price is above the 8 of the 10. The odds and probability that part of the change of trend is highly probable. It confirmed it from this higher low with a new higher high. The odds that it will continue potentially to the first level of retracement is highly probable to go to 33.50. Hence, if we're going to buy it on this side, your risk is now 60 pips. Prior before that, if you're buying at demand, was 30 pips. 60 pips to 30 pips, it's times 2. How about the reward? The reward from here to there is 102 pips. From here to there is 60 pips. So there's at least about 30 to 40 pip difference. Well, I'm sorry, not at the time from here. From the low, 70 pips. Okay. So just to prove and show once again that to get from here to almost to the top, 91 pips versus here to there is 50, 60 pips. That shows and proves that indicators like moving averages is a retail price point, and moving averages is, mind you, is the average, which is now the equilibrium between supply and demand, between the high and the low. That's basically what the average is. And hence, when you're dealing now with that is in a retail price point, the risk becomes higher, reward smaller, probability, of course, depending on the system that you're using. Like I said, if the probability is high, with the risk is high, with smaller reward, will I still place in the trade? Absolutely, but I just have to decrease in terms of position size. Right, so there's basically just to show to you there, Kamal, that indicator type of trading versus no indication, just purely price dictates and in terms of the direction. So what I've, to recap to show you here is that there are a few things. One, in dealing with price, news-based, that creates supply and demand, that creates basically the trend. Reading the trend is also knowing whether if you're with the trend or not with the trend. And how do you know what is in the trend? Is by defining those definitions of higher highs, higher lows, lower highs. And then you can create your target points based on distance. You can create your own probability based also in the distance. All right, so that's how we would be able to trade objectively, that if we can be objective, specifically what it means, what technical analysis means, what trends means, what we're looking for to create the movement based on price, based on news, what type of news that we need to look for, like the macro fundamentals. Then you have a better odd of when you can create the probability. And once you create the probability, create the odds, then you can place the trade. Any questions there, Kamal? Any questions? Well, if you don't have any questions, Kamal, well, thank you for coming in. I hope you learned something today. And if you need to know more, email me. My email address is esttraders@gmail.com. It's hard to buy at that low price point. No, of course, there's the other one thing that it takes more in terms of topic is multiple time frame analysis. So you can expand and you can actually buy at that low price, to be honest with you. By going through either 4 hours, even 1 hour, you can see based on the 1 hour. See right there, you can get in specifically at that price point before even news actually hits. So if you can expand that, that's what we call multiple time frame analysis. The previous chart, like this one, right? So even if I go through a smaller time frame, like the 1 hour, once there, everything is stagnating depending on the time frame. So here, 10 in the morning, Eastern Standard Time. You have a confirmation, nice big boost, and that's how you can get in actually at the wholesale price point. All right, thank you so much for coming in. Well, yeah, so basically here is, that's why the news is so important for you. So sometimes I get in prior to the news, and then if you want more certainty, you wait for about 10-15 minutes for the news to actually hit, and once a special direction happens, boom, you got to go with it. Once you're in it, bingo. You just have to wait. At certain time, it goes in waves, right? It creates the impulse. From impulsion, then stagnation, either correction or continuation. So like this one, hit the 133, stabilize, news hits, boom, impulsion. Okay. Yeah, there's a, sorry, using go before the news. Yes, absolutely, definitely. But if you want more certainty prior to the news, then wait. If you want more certainty. But in most cases, anyway, I mean, they already left some form of trails in there, and you can just basically go in even before the news. You can see before the news is happening. You go through a smaller time frame, you can already see what they're doing. They're pushing the price. And then as long as you're going to be with the trend with it. If you're with the trend, awesome. Especially if something's just way oversold. Yeah, and they've been buying bit by bit, because institutions cannot go by all at once, or they get hit, right? They can go through small and small again, small. So you'll see in terms of the volume, in terms of a spike in smaller time frames. Yeah, perhaps there'll be another session, but nevertheless, this all goes through. I go through all basically in the classes, basically in our class. Yeah, but at least I'm giving you some form of piece of information here that you'll be able to utilize, and then later on, I mean, if you guys want to continue or ongoing education, let me know, and I'm more than happy to help you guys out. All right. Yes, I am a coach. I've been teaching for the past 15 years now. I've been, like I said, full-time training for the past since 2002, so 17, 18 years. Been trading since 1996, actually. So yeah, seeing pretty much a lot of waves in the marketplace. And yeah, trading, of course, is challenging, especially if you're looking at two-dimensional charts. Sometimes we're not aware of our thought processes, and if I'm using my own perception, I don't have my own, what do you call it? If I'm having enough facts, then the odds that I'm going to lose as well is highly probable. Right? So, for example, I'll just share just one of my accounts. Like, if these are the things I want to minimize, especially like this is the thing with the minimization. So where if every day, or actually at the end of the week, as part of our group coaching, is a performance-based class where we need to look in terms of part of reflection is, okay, why was that a big loss? So I have to go through that and see, okay, I increased in position size. What did I didn't see? Sometimes, even we have in terms of objectivity, but there's news hits like this all about Trump. If Trump says something, hey, look, sometimes it's not about us. It is, we have no control. And hence, that's why we've got no control on whatever Trump says. And that is unfortunately, you have to accept that if you're willing to take that risk, then so be it. So, but as part of the reflection is you have to look at, okay, did I fully really accept it? Was it really me or was it the markets? So in this particular case, it was the markets. It is what it is. And still basically after that, taking a bigger, as long as the profits are bigger than actual loss itself, and that's all that basically that matters, right? So that's the way how I look at trading. The indicators have a form of hierarchy, in my opinion. Price will always go first, supply and demand will always go first. We're getting a wholesale price point. Then you have different indicators that have different purposes. Moving averages will always going to be last. So I have 3 different trading methods. They go 1 or 2 and 3, and then have different strategies like a trifecta, for example. I will keep buying until it gets exhausted. But a strategy I always utilize is that once my stop loss above break even, then you have infinite reward. Okay, so that's different strategies, different money management strategies, different risk management strategies. As long as you end up winning at the end of each month, that's all basically that matters. So it's the key is consistency, right? So yeah, and also the psychology component. Yeah, if you're asking what whether if I'm coach, yes, I'm NLP certified, so I deal a lot with the mental component. You know, and to have a program that's actually 8-week. It's an 8-week course in terms of mental conditioning, but it's two times a week class. But live trading is every day. That's why I use the currency markets, because it's really important to prove that the theory works in real time. Anything can trade, anybody can trade, anybody can teach. The question is, how can you really prove that the theory works in real time? So like say, what basically showed you here, that if this one finishes like this, what are the odds that it's going to go beyond that? It takes time though, because it's a daily time frame. But in order to do so, we put in a trade in order for it to work. So we put in a trade in the currency market. So like say today, like, you know, observe it. Will it go beyond there? Can it go within that distance, $2.50? That's basically what the challenge is today, right? The challenge or the theory based on what we discuss, will it go there? If it worked, awesome. If it doesn't work, then the question is why? So then how can we make it better? What is it that we missed? So all these things plays a very big role. In my opinion, I believe you can't do this on your own. That's why I love still teaching, is because if when I'm talking, then I can still be able to see things objectively. And it becomes easier because if I know which one's which, and I just place in the trade, and we place in the trade as a group within our trading group. All right, guys, thank you so much for coming, and hope you enjoyed it. Like I said, if you have any questions, please, you can email me here, esttraders@gmail.com. Or you can also call me anytime. This is my private number, 650-390-7104. I'm based here in the border of Mountain View, Sunnyvale. And I'm more than happy to meet with you guys if by all means, yeah, and discuss about trading. Or if there's anything I can help you with to be either a better trader or more consistent, and that's awesome. All right, guys, take care until next time. Happy trading, guys. See you later.